Guys, great to see you both. David, let me start with you and ask, you were with us a few days ago and sort of framed this process as baby steps toward the Fed's endgame. Is this another baby step or something more than that?
I mean, it certainly feels like a bigger step, Carl, this morning, 4 on the S&P and 5+ on the NASDAQ. It's a big miss to the downside. It's a lot of relief. I think it takes away from the aggressiveness that we heard in Jay's press conference after the last FOMC meeting, but it's nicely consistent with the statement. The statement was talking about lags, about cumulative tightening, and I think we're going to start to see that play more in Fed commentary, maybe more like what Charlie Evans was talking about earlier. And I think it takes us much more into this fine-tuning phase. We've done the heavy lifting. We got 400 basis points done already. We're going to have 450 or so by the end of the year, maybe 475. And we've got a lot of QT to get through. We're going to have 500 billion of QT by the end of the year. So there's a lot of tightening in the hopper. And we're starting to see, the benefits that the Fed is looking for, at least some signs of them coming through. And I think the market's really going to key off that, and obviously has.
Yeah, definitely this morning. Omar, it sounds like maybe you are tuned in maybe a little bit more to longer-term structural stickiness in inflation that could haunt us for years.
Yes, absolutely. First of all, obviously the market was starving for some positive light that this was actually working somehow. And I think over the last few months we have seen the market's taking so much on the negative side of all asset classes, fixed income, equities, commodities. And I think, a report that shows a little bit of light at the end of the tunnel obviously has been incredibly well received by both, bonds and equities. But long term, the pace and, the whole concept of what we're talking about here is really just, the deceleration and the acceleration of, higher rates by the Fed and central banks around the world, how fast they can go towards a more restrictive monetary policy. And at the same time, the pace of the deceleration of these inflation pressures. And, as you stated, the longer term reasons of why we got into this place, they're still there. And that is going to probably just, have a lot of questions probably closer to the terminal rates than what it is, whether it's deglobalization, whether it's demographics, whether it's overall just the overall landscape of how we move towards renewable energy. All those costs will probably stay with us for longer than what I think officials may actually have in place.
Hey, David, we're talking about an extraordinary morning here so far, just the amount of market cap being added. I got Amazon up 10% on no news other than this, and then Apple and Alphabet and Microsoft, again, the biggest of the cap companies out there, adding 6-7%. Is this the beginning of something new, or is this a fake out?
So, David, look, I think there's not a back up the truck moment here. We're going to new highs. That's not the story. The story is that we have a very nice cushion on the downside. We've got a lot of nominal GDP growth that's been very helpful for earnings, very helpful for valuation. And we're going to push back up and see if we can get to that 4,300 level, which I think is very doable. I do think up there, though, David, the Fed is going to come kind of at you like they came at you in Jackson Hole and say, look, guys, we still have this inflation. We still have this, mark on our report card that we're not very happy about. 7% in 2021, 8% going down now to 7.7 in 2022. They're gonna use opportunities of strength in the market and easing of financial conditions to just get to their goals a little bit faster. It doesn't mean they're going to tighten more. It just means they're not going to come down that